with today's material because otherwise we will not get through it. This is the answer to yesterday's quiz. So as you can see, entry was here. Then you have an adding position, add further updation of stops, and finally you are able to get out here. Now these are all cases which have worked out. Sometimes it will work out only till here. And in that case, you should have your stops ready. Every stock will not move like this. So try to line up things as well as possible so that things are able to move well. So today we are getting into the pivot methodology. Pivot methodology is also a trend following methodology. So basically most methodologies are trend following, although pivot leaves an allowance for sideways also. Similarly, the moving average method, even that has a sideways angle, where in a sideways market the high and low of yesterday or the previous corresponding period. So that being said, let's first discuss what is the principle behind pivots. Okay, now this is initiative seller. This is a mistake. The market structure can be defined as it generally remains in a range where at the lower end of the range the responsive buyer buys and the responsive seller sells and keeps the market in a range. But when there is news or other kinds of buying, this range is broken out and now the initiative buyer takes control and he is trying to take this equilibrium to a higher level. This is the basic structure of the market, that a market will remain range bound till some catalyst takes the price higher and this equilibrium shifts either higher or lower. Similarly, on the downside, the responsive buyer keeps the market in a range, and if it breaks on the downside, the initiative seller comes in and he takes the market to a new equilibrium on the downside. This is the basic theory of pivot. Now, just so that the thinking is exactly the same like moving average. If I draw 200 here, this is your 200. That is equilibrium. So whenever you have a sharp move out of a ranging action, your equilibrium shifts. That is the reason we want to buy or sell near the 200, because we want the initiative buyer or initiative seller to take control. So the theory that we discussed in moving average is exactly the same as the one we are talking about on pivots. The names are different, the price levels are different. On moving average, we are talking about previous day high low. On the pivots, we are talking about S1 R1. Okay. Now the pivot theory, as I said yesterday, the system that I follow is by Frank Ochoa, who is the pivot boss. His book is highly recommended. He has several types of trainings also, which you may want to take. But clearly, the way he has explained the structure of markets has made things quite a bit clear. So let's move forward with this sort of a structure and see how we can trade pivots. Now these are pivot conditions, nothing fancy. Basically, Frank Ochoa has added the lower pivot point and the upper pivot point. The rest of the equations are the same and they are all available freely on the internet. The idea is not to know the calculation. The idea is to, we have also given you a spreadsheet which you can learn to update every day. Every day you will have new levels. Now pivot theory was actually used by floor traders in the US, and in my opinion and in the opinion of many seasoned traders, this is probably the only predictive method in the market. Why? Because rest is opinion. It gives you tomorrow's levels with today's data, and that is predictive. So let's see how we can predict and get a very good idea of how to deal with pivots. These are calculations. I think Pivot Boss book has been sent to all of you. Okay, the Pivot Boss book can be ordered from Amazon, but we made a spreadsheet and that you people have received. If you have not received it, please contact the office and they'll send it to you. Okay, now this is the pivot point. This is the upper pivot point. This is the lower pivot point. This is called the central pivot range. Why? I explained yesterday, support and resistances are zone. Similarly, the pivot point is a zone. It is not a single point. So the great contribution of Frank Ochoa is made this pivot point into a zone. Again, what is this? This corresponds very well to the 200 period average. So the daily pivot is almost the same as the 5-minute 200 period average. What is this? This is previous period low. This is previous period high. So basically everything leads you to the same story. I am just making relationships with what we learned yesterday so that this is nothing new. This is the same thing with different names. That is according to chart. Here there is no chart, there is only numbers. So you can, although from our office, ask for Amy Broker, where we have programmed these pivots on a chart. So that sometimes makes it easier to look at pivots. Let's move on. This is how the pivot points look. I have taken the price off. So if the market is trending, this central pivot range will keep moving higher. Similarly, R1 will keep moving higher, S1 will keep moving higher. So this is how a trending pivot depiction looks like. Now what do you do? Once we know it is trending, how do we know? Because this central pivot ranges are moving up. So it's a upward trending market. So if we open here, you often heard people say buy on dip. You wait for the price to hit the pivot and then buy the dip. Again, what is the pivot? It is 200. Where can you put a stop? S1 is the ideal stop, but you can use a stop here also if the stop is too wide. So every day it comes up, use the decline to trade the other side. Why shouldn't you buy here? Because then your stop becomes very wide. So low risk buying is done when the price retreats towards the pivot and goes up. This is how a trending pivot is traded. Now what are the key attributes of pivot? A, there is trend following. Open is key for pivot points. C, they are mean reverting. In a sideways market, when market gets to one extreme, it reverts back to the pivot. Also volatility. Volatility, low volatility leads to high volatility leads to low volatility. Nothing different from what we learned yesterday. So trend following I just showed you here. This is a pivot on the downside. So if a market is going down, these are the kind of pivots you are likely to encounter. So again, this is sell on rally. So this is your zone which decides that the trend is still intact. Okay. Where do you keep a stop? Below these pivots most of the time, but if R1 is very near the pivots, even R1 can be used as a support. Till R1 is held, we are going to move lower. These are sideways pivots. So basically in a sideways pivot, you fade boundaries. On S1 you buy, on R1 you sell, again next day R1 you sell, S1 you buy. Now will it be always very well defined? No. Sometimes it will be all over the place, but if you can make out where the boundaries are, that is the way to trade a sideways market. So sometimes what will happen is this is sideways, it goes up and makes another range. So this will happen. So the idea should be if prices are confirming hitting of bottom, only then trade it sideways. Like in the market these days, lot of action is sideways. So a trend following methodology does not perform as well in a sideways market as it does in a trending market. But it's possible to do profitable trading even in a sideways market, and we'll talk about examples. Again, the boundaries sometimes can be up or down. So only trade the pivots where boundaries are consistent. Okay. Now we discuss trend following. This is a compressed chart. All it's trying to show you is if you see a longer term chart, 15 days, 20 days, how does the pivot look like? Now see here, the market started from here and immediately started breaking the pivot. This is again, I repeat, 200 which is getting broken. Rallies back up and finds support, finds resistance at the pivot. So again, big downside bar, and you just follow through, and by end of day you are able to cover. Next day we open near the pivot, again find resistance, and we are able to cover at lower levels. I have marked the 200 here so that you can get a basic idea of what is going on. It is a sell on rally market, right? So each time we are going towards the pivot, selling the market would have made sense. We'll get into smaller time frames also, but this is just I am generally trying to tell you what pivot is about. This is the buying side. We opened above the pivot with a gap and kept going. Again next day we corrected towards the pivot, we bought and we made some money. Again here the price opened touching the pivot and you got this. So basically buying made money because every day the prices were higher than the pivot, right? So the idea should be to buy the dips mostly. Here if you bought the dip, it didn't work out, fine. Out of 6 days, one day may not work out. But what you have to keep in mind is buy the dip, buy the dip, buy the dip. Dip till where? Dip till the pivot. There is a 65% odds that every day you will hit the central pivot zone at least once. I repeat, what is central pivot zone? These three lines. This is the zone of the pivot. Okay. Theory is that from a range, market is breaking out and creating a new equilibrium. So basically this block is now your support. So every day this block moves up, and this is the central pivot zone moving up here. This was the sell side, sell the rips. Each time we hit pivot, you sold, you made money. Again, it hit pivot, sold, you made money. Again, this was a big day. This is a large bar. This is at least a 300-point bar. So even here, you could have gotten short at 50% zone. Again, hit pivot, you sell, and by end of day, you made money. Why? Because this is a downtrending market. Okay, let's move on. Now the open. The open is very crucial in the pivot system. Why is that? Because like I explained yesterday, or rather today, that we are looking for the initiative guys to come in. Now this is the central pivot zone. The initiative seller or the initiative buyer in general are coming either above R1 or below S1. What is S1 R1 corresponding to? Yesterday high low. So in case previous day is a narrow range day and we start to open below S1, the odds are market will start to trend. Can you see both these days the pivots were close by. So this was sideways day. I think before this also there was a bit of sideways. So if in a sideways market, the market opens with great momentum on the downside, you tend to get follow through. Okay, again you know your trade management. Same trade management can be used here. So only the method of entry is different, but the principle is the same. So lesson number 1 of open is, if the market is opening below S1 or above R1 and previous day is a range bound session, low volatility session, the odds of trending have become high and you should chase the market, which means sell below S1. Okay. Two conditions: narrow range previous day or several days of range bound movement, and the market is beginning a new phase of expansion. I use two words very frequently: expansion and contraction. This is expansion. This is contraction. We want expansion to be able to make money. This is another example. Now what happens if the pivots were moving on the upside, you were in an uptrend, and suddenly next day you have a gap down and the market starts to fall. So in case generally the way trends end that you had this upside going on, and the next day the market opens below the pivot and keeps going lower. So this is a trend change. So the day after this, you will start to get pivots on the downside. So often trends are changed with gaps. Why? Because all these guys who are long here, the moment it gaps down sharply, all of them become losers and they cut positions and market goes on. How does this sort of large movement get created? This movement gets created because the long positions here, their stops are hit. So even if you got in here below S1, look at this move. This is at least 300 points on Bank Nifty. That is where big bars work, because big bars are created by initiative sellers or initiative buyers. Got it? Just keep listening to me and note down your questions. We will come to questions, because in your enthusiasm of questions, if you miss out what I am saying, then there is no point. Second type of open is the open is within the central pivot range and within previous day range. What does that mean? That the market is likely to trade sideways, and it may not even touch S1 or R1, but there will be very limited opportunity. The best opportunity is when the open breaks previous day high low or S1 R1 and gives you a trend. On such a day, trading the Bank Nifty or any index is not very useful. As you can see, this is a sideways market, right? In fact, this is a trend change market, because these pivots are going up and suddenly you have a gap down which rejects this pivot zone at the open, and the price starts to come off. Why have we covered here? Because we are reaching a previous low. What did I tell you? Where do you cover? You always look on the left. On the left you have a significant low. So this is where you cover. You are going up, pivots are rising. Third day we have a sharp decline and the pivot zone is rejected in the first instance. So you sell here, you find some resistance, and slowly the market collapses because all of these long positions are cut and their stops are hit. Again, if you open within range and value, the market is sideways. Now there is a third situation where open is equal to, open is within S1 R1 but outside the CPR, which means it is here somewhere. In this case, you cannot tell at the open where the market will go. Often what happens is it starts range bound, and if it takes previous day high or previous day low out, then a trend starts. So this is half a day of a range plus half a day of trend. So you should be ready to see the breakout of previous day high or low or S1 R1 to find a trend. So there are three situations. At the open, you know SGX closing. If open is greater than S1, and open means first 15 minutes. Don't make things so specific that you lose the principle. 10-day possible. If open greater than CPR also. Obviously, if S1 R1 is crossed, it is greater than CPR also. If open inside S1 R1 and inside CPR range bound day. If open greater than CPR, which means either above or below, but inside S1 R1, then the market will start range bound, but during the day it may take S1 R1 out and start to trend. So maximum opportunity is here, where we are opening with great amount of force. Minimum opportunity is here, where the open is very mild and it's not even touching S1 R1, not even coming out of CPR, and this is medium opportunity. Remember what we talked about, low, medium, high volume. So that is how you decide what kind of volume you have to do based on the kind of opportunity that is there, right? Now we have mean reversion. What does mean reversion mean? That sometimes the price opens above R1 and comes back towards the pivot. Now if you people recall, I think last week some trading window for HDFC Bank had opened up, and HDFC Bank opened I think 2.5% higher and started to show you mean reversion, which means the first bar was a huge red bar. Let me see if I can show you that example. कौन सा डेट था? ये था 10th. 4th. 4th June. ये 1st जून है, नहीं भैया 1st जून को कोलैप्स है. This is that day when everybody expected HDFC Bank to go up 5%. Okay, so this is that mean reversion day. A lot of you wanted to know when to short above 200. This is the day when something opens up because of news. There is no follow through. You went short on the first bar, and within 1 hour, I think HDFC Bank was down 3-4% from the highs. So mean reversion often happens when there is some positive news and there is no follow through, or there is some negative news and there is no follow through. Okay, so that way, news is better, but the other way mean reversion can happen is that if it's a sideways market, like on Friday, you gap down, that gap wasn't sustained, and the market started to come back. Okay. We'll talk about many more examples. So, understanding of this is that things open beyond R1 but are not able to sustain, open below S1, not able to sustain, 95% accompanied by news. Okay. See, this is previous day, we end up at the high. Next day, we open, try to go higher, but previous day high does not sustain and we start collapsing back. So this is called mean reversion. This is the mean. And reversion means you go to one extreme and collapse back. Again, this is a low, market opens at the same low as previous day, does not sustain and start to go back towards the mean. Now understand this, that if today is a trending day, the odds of tomorrow being a trending day are low. Say if tomorrow is also a trending day, then day after is a range bound day. So again, volatility alternates. So if you have a huge day today, it is not sensible to go ahead tomorrow morning with a 30-point gap and go and buy. Why? Because you are so far away from your equilibrium that at any time a sideways move can take you out. Okay. Hold on to all questions. A lot of things will be clear as you go through examples. Don't be over eager that please explain this from the beginning, that from the beginning. That is not possible. Please try to understand what you can. Once question and answer starts, you will be able to understand better. Again, collapse. Second day, no follow through, and again you have mean reversion. This was the day when you had surgical strikes. Next day, market opened lower, no follow through, and went back up because in the opinion of the market, it wasn't going to lead to any big conflict. Let's discuss what is contraction. This sort of sideways days are contraction, where you end up at the low of the day one day, touch high of the day yesterday, the next session, again open at the low of the day, next session gap down, not sustained, gap up, not sustained, something similar to what we are going through these days. So this is a contracting market. Here, chasing will not work because the initiative guys are pushing back the market towards equilibrium. Again, contraction. Broadly, the boundaries are defined. So once you get this point and you get this point, the boundaries are confirmed. Now all you have to do is, if price gets here and you see a negative candle or a positive candle, you take the other side. Where does the biggest opportunity lie? Okay, now pivot theory. This is the basic of pivot theory. After this, we'll get on with expansions, but very important to be clear on the basic. You will have many examples. We are just starting out with examples. But is the basic clear? What is the basic? That you have a market which is in a range, responsive buyer here, responsive seller, but if there is a impulse move, then it takes the market and takes it into a new equilibrium. Same thing on the downside. So where is the biggest opportunity? Here. Here the opportunity is limited because things are range bound. This is in a nutshell. Rest of it is all, mechanics and how different sorts of opens. If a person, how do you deal with these different things? I would trade the biggest volume on this opportunity. I would probably do lower volume when it's more range bound. I would do medium volume the day we are sideways, and middle of the day we break out of R1 or S1. So heavy, light, medium. Okay, question answer time, but please, I cannot do the entire section again. Ask me specific questions about the area where you have a problem. The upper pivot point, the lower pivot point, and the pivot point, when they coincide, when pivot range is narrow, what does that mean for the previous day? That means the previous day was a narrow range. Only then the pivots can narrow, right? So whenever they are coinciding, you should expect a trend day on the next session. What did we discuss in moving averages? That if you have a narrow range day and there is an impulse move, it creates an upside. I do recommend Secrets of the Pivot Boss. Where any software that can be programmed can be used to program the pivots. Examples will come later, not at this point. First, we'll do the examples that are part of the presentation. Why should the market fall to cover those shorts? Don't ask silly questions. If there is a short covering bounce, obviously the shorts will cover. Weak shorts will cover first, strong shorts will cover later. See, shorts will cover after a big downside when the market is reaching some sort of support. If a market has had 5 or 6 days of waterfall, like you have been trained that if you start seeing vertical moves, you cover. Similarly, shorts cover. See, you people are asking me these TV style questions. Please ask me something objective which can be used for trading. Nobody knows when shorts will cover. The stupidity of here on television is useless. Forget it. Focus on this presentation. See, a consolidating stock, according to me, the best way to see it's consolidating is to look at the chart. But still, if you want to look at the pivots, that's up to you, but I don't think they had any value to find consolidating stocks. If a price action is sideways, it's consolidating. One more important thing I would like to mention is pivot width. When pivot width is narrow, and narrow means the pivots are almost coinciding. Here the indication is if tomorrow we open above R1, the odds of trending day are very high. So what you can do is that find all stocks, and you may need a scanner to do that, where the pivot width is narrow. Have a nice list of 10 stocks, and wherever the market shows you follow through, chase it. Pivots in Zerodha, again, Zerodha is not the professional software. I like to use professional software because the levels are kind of similar to mine. But pivots are zones. If Zerodha is showing you 25,250 and your calculation is showing you 25,000, then there's a problem. Sir, let's restrict ourselves to the pivot principle. Don't ask, questions which are ahead of time. I think there are no more relevant questions on the pivot theory. Now, when would you find the pivots wide? When previous day is a large day, because high, low and close divided by 3 will be far ahead. So try to understand this one simple thing, that say it is a trending market. This is day 1, this is day 2. So here the pivots will be separated by a large distance, which means this pivot will be quite a bit far away from this one, right? So this indicates that the market is more trending. If day 1 pivots are here, day 2 pivots are here, this is a comparatively weaker trend than this one, right? Because this will be formed by a more range bound action. So keep this in mind, that where pivots are placed shows you the strength of trend. That is point number 1. Point number 2, if day 1 is a large range day, next day you will have wide pivots. If narrow range pivots indicate that today will be a trending day, wide range pivots indicate today will be a sideways day. So this should be the expectation, that today I do not want to act at higher level. I would wait for some correction and only then act. This will bring your risk reward to a favorable zone. Because often when you have a wide range day, on Bank Nifty this could be 25,300 and this could be 25,100. So there could be a 200 point distance. So the idea is, on a sideways day, you must wait for the central pivot range to come in before you think of acting. Okay. There are 3 conditions: open greater than R1, S1 or S1, and greater than central pivot range. So it opens beyond everything. That is a trend day. Open greater than CPR, ये वाला पेन यूज हो तो रहा है, पीले वाला equal to S1 R1. By equal to I mean within. Okay. So on this day we start range bound and then we wait for S1 R1 to get taken out to get a trend. This is medium opportunity. This is high opportunity, and if open is equal to CPR, which means inside the range, inside S1 R1, then opportunity is lowest. Here you will at least try to trade the range. Here the range will be so narrow that you cannot even trade the range. Maximum opportunity is here. I know people who only wait for this to happen to take the trade, and this you know before the market opens. Rest of the time they enjoy, because the day this happens, the market does not look back and keep going and going and going till the end of day. So it is possible, looking at the SGX, to assess whether there is good opportunity today or there is low opportunity today. See, there are various ways to use both these things. I like to see everything, but there are other people who may not like to use both the methods, or you may decide you will use it in a manner differently from me. That's okay. This lays out the information. This gives you location. This gives you, what kind of day you are expecting. The best is to look at both things and then to reach a conclusion where the weight of evidence, theory comes in. But otherwise, my sense is both these things are independently very powerful, and even individually, they are most powerful. Why? Because both these things tell you when the market, like I would use pivot to assess whether today will be a trending day. I would use moving average for individual stocks because it's impossible to make pivots for everything. So I use pivots for indices and moving average for individual stocks. But somebody may decide these are my 10 stocks, I will do pivot on this. That's absolutely fine. Mainly it boils down to trade management, money management. But if you are getting confirmation from two different systems, these are two different systems. Why? Because they are using two different calculations. So this is where confluence comes in. If two things are giving you the same conclusion, often it is powerful. Now let's take a 15-minute break and then come back with examples. Don't worry, anything that you have missed out, want to ask, will get cleared as we do more examples. That is the reason I am not taking very stock specific type questions because a lot will get answered. I will not leave this chair till all of you are satisfied with the answers. So just hold your breath. What happens is once we are thinking about, I need to ask this, I need to ask this, we are missing out information that is being told. So just bear with me. Everything will get answered. Just wait for the time to come because a lot gets answered when the presentation happens. Thank you. We will meet at I think 10:05. Have your tea and restroom break. We'll come back.